Let me ask you something that most investors never think about. What if I told you that the secret to building generational wealth has nothing to do with finding the next big growth stock, nothing to do with timing the market, and nothing to do with complicated trading strategies? What if the real secret is finding companies that pay you money every single quarter, year after year, decade after decade, and never stop increasing those payments? Most people chase stocks that might double or triple. They get excited about companies that could be the next big thing, but they completely ignore the businesses that have been quietly making shareholders wealthy for 50, 60, even 70 consecutive years. These are called dividend kings, companies that have increased their dividend payments for at least 50 consecutive years. Think about that, 50 years of increases through recessions, through wars, through financial crises, through everything the economy could throw at them. And today, I am going to share with you the 3 dividend kings that I will never sell, not tomorrow, not next year, not ever. I am going to explain exactly why these 3 businesses deserve permanent places in any serious portfolio. I am going to show you the mathematics of how dividend growth compounds over decades, and I am going to teach you principles that can help you build wealth regardless of where you are starting from today. Now, before I reveal these 3 companies, let me take you back to a moment that completely changed how I think about dividends and long-term wealth creation. It was 1967, and I had just made what I thought was a brilliant investment. I bought shares in a company that everyone was talking about. The stock was hot. Analysts loved it. The price was climbing week after week. I felt smart. I felt like I had figured something out. And then about 18 months later, the company hit some trouble. The stock price collapsed. I lost a significant amount of money on that investment. But here is what really bothered me. During that same period, my friend had invested in what he called boring dividend stocks, companies that nobody was excited about, companies that just paid steady dividends quarter after quarter. While I was watching my hot stock disintegrate, he was collecting dividend checks. And when I sat down and actually calculated his total return over those 18 months, including reinvested dividends, he had made money, real money, while I had lost. I remember sitting in my office staring at those numbers, and something clicked. The companies that pay you while you wait, the companies that share their profits with you consistently, those are the companies that build real wealth over time, not the exciting ones, not the ones everyone is talking about. The boring ones, the reliable ones, the ones that treat shareholders like partners in a real business. That lesson cost me money to learn, but it was worth every penny because it shaped how I have invested for the past 6 decades. Let me tell you another story that reinforced this lesson. Back in the early 1970s, there was a period when inflation was running hot and the stock market was struggling. Many investors panicked. They sold their stocks, sometimes at terrible prices, because they could not handle watching the quoted value of their portfolios decline. But the dividend investors I knew were different. Yes, their stock prices were down just like everyone else, but every quarter the dividend checks kept coming. In many cases, those dividends were actually increasing even during that difficult period. And because the dividends kept coming, these investors did not panic. They had income, they had cash flow. They could pay their bills without selling anything at depressed prices. Some of them even used their dividend income to buy more shares when prices were low. When the market eventually recovered, these patient dividend investors had accumulated far more shares than they started with. Their income streams had grown substantially, and their total wealth had compounded dramatically compared to the investors who had panicked and sold. That is the power of dividends during difficult times. They provide stability, they provide income, they provide the psychological anchor that allows you to stay invested when others are running for the exits. So what makes a dividend king so special? And why do I consider these 3 companies to be permanent holdings in my portfolio? Let me explain my framework, because understanding the criteria is just as important as knowing the specific names. A dividend king has increased its dividend for 50 or more consecutive years. That is the basic qualification, but I look for much more than that. I look for companies with genuine economic moats, competitive advantages so strong that no rival can easily steal their customers or replicate their business model. I look for management teams that understand capital allocation, that know when to invest in the business and when to return cash to shareholders. I look for products and services that people need, not just want, but genuinely need in their daily lives. And I look for financial strength balance sheets that can withstand any storm. When a company has raised its dividend for 50 consecutive years, that tells me something profound about the business. It tells me that through every economic cycle, through every challenge, management prioritized returning capital to shareholders. It tells me the business model works because you cannot pay increasing dividends for half a century unless the underlying business is generating real growing profits. And it tells me there is a culture of discipline and shareholder respect that has persisted through multiple generations of leadership. Think about what it takes to raise a dividend for 50 consecutive years. You need to survive recessions. You need to adapt to changing consumer preferences. You need to fend off competitors. You need to navigate technological disruption. You need to maintain profitability through wars and crises and pandemics. These are not characteristics you can fake. These are characteristics that are earned over decades of consistent execution. So let me tell you about the 3 dividend kings I will never sell. And more importantly, why each one deserves a permanent place in any serious investor's portfolio. The first dividend king I will never sell is Procter & Gamble. Now, some of you might think this is an obvious choice. Procter & Gamble is a household name. Everyone knows their products. But let me tell you why this company is so much more impressive than most people realize, and why I consider it one of the finest businesses ever created. Procter & Gamble has increased its dividend for 68 consecutive years. 68 years, that means they started raising their dividend in 1956, when Eisenhower was president, when the interstate highway system was just being built, when most Americans did not even own a television set. And every single year since then, through Vietnam, through stagflation, through the savings and loan crisis, through the dot-com bust, through the financial crisis of 2008, through the pandemic, every single year, they raised the dividend. Let me put that in perspective. In 1956, a first-class stamp cost 3 cents. The average house cost $11,000. The minimum wage was $1 an hour. The world has changed almost beyond recognition since then. But through all of that change, Procter & Gamble kept raising its dividend. That consistency is extraordinary. Let me tell you a story about Procter & Gamble that illustrates why this company is so resilient. Back in 2000, the company went through a rough patch. They had expanded too aggressively. They had acquired some businesses that did not fit. The stock price dropped significantly. Wall Street was bearish. Analysts were downgrading the company. Some were even questioning whether the dividend streak could continue. It would have been easy for management to cut the dividend, to preserve cash, to hunker down and wait for better times. But they did not do that. Instead, they restructured the business, sold off underperforming brands, focused on their core strengths, and continued raising the dividend. They did not panic. They did not abandon their long-term shareholders. They worked through the problems methodically while maintaining their commitment to dividend growth. Within a few years, the company was stronger than ever, and shareholders who held through that difficult period and reinvested their dividends were rewarded handsomely. That is what I mean by resilience. That is what 68 years of dividend growth really represents. It represents a culture, a commitment, a way of doing business that transcends any individual leader or any temporary challenge. Now let me explain why Procter & Gamble's business is so durable. They sell products that people buy every single day, regardless of what the economy is doing. Tide detergent, Crest toothpaste, Gillette razors, Pampers diapers, Bounty paper towels, Charmin toilet paper, Downy fabric softener, Head & Shoulders shampoo, Oral-B toothbrushes, Old Spice deodorant, the list goes on and on. These are not discretionary purchases. When times get tough, people might delay buying a new car or a new television, but they do not stop brushing their teeth. They do not stop washing their clothes. They do not stop buying diapers for their babies. This is what we call consumer staples, and Procter & Gamble owns some of the most dominant brands in virtually every category. Think about the economic moat here. When you walk into any store anywhere in the world and you see Tide detergent on the shelf, that is decades of brand building at work. That is billions of dollars invested in advertising, in product development, in distribution relationships. A competitor cannot just wake up one day and decide to challenge Tide. They would need to spend billions to build comparable brand recognition. And even then, consumers have emotional connections to these products. People grew up using Tide. Their mothers used Tide. Their grandmothers used Tide. That brand loyalty is incredibly sticky, and it translates into pricing power. I remember visiting a Procter & Gamble facility years ago, and what struck me was the focus on continuous improvement. They were not resting on their success. They were constantly working to make their products better, to make their manufacturing more efficient, to understand their customers more deeply. That culture of excellence is why they have maintained their competitive position for so long. It is not enough to build a great brand. You have to keep investing in it, keep improving it, keep earning the loyalty of customers generation after generation. Procter & Gamble understands this better than almost any company I have ever studied. Their research and development efforts are world-class. They file more patents each year than most technology companies. They innovate constantly within their categories, finding ways to deliver more value to consumers while maintaining strong profit margins. That pricing power funds the dividend increases. The company generates enormous amounts of free cash flow, far more than they need to reinvest in the business. And they return that excess cash to shareholders through dividends and share buybacks. Currently, Procter & Gamble yields around 2.5%. That might not sound like much compared to some higher yielding stocks. But here is what you need to understand. That dividend has been growing for 68 years. If you had invested $10,000 in Procter & Gamble in 1990, just reinvesting the dividends, you would have over $200,000 today. And your dividend income would be many times what you initially invested. That is the power of compounding dividend growth over time. Looking forward, I see Procter & Gamble continuing to thrive for decades. They are expanding aggressively in emerging markets where billions of people are entering the middle class for the first time. When families in India or Indonesia or Africa get disposable income, one of the first things they buy is branded consumer products. Procter & Gamble is positioning itself to capture that growth. They are building distribution networks in these markets. They are creating products specifically designed for local preferences and price points. They are investing in manufacturing facilities closer to these consumers. They are also investing in e-commerce, in direct-to-consumer channels, in sustainability initiatives that resonate with younger consumers. The company is not standing still. They are evolving and adapting while maintaining the core strengths that have made them successful for over a century. Some people might argue that Procter & Gamble is too big, too mature, too boring to generate exciting returns. But I am not looking for exciting. I am looking for reliable. I am looking for companies that will be bigger, stronger, and more profitable 10 and 20 and 30 years from now. Procter & Gamble fits that description perfectly. I would rather own something boring that compounds steadily than something exciting that might blow up in my face. The second dividend king I will never sell is Coca-Cola. And I can hear some of you thinking, of course, he picked Coca-Cola. He is famous for loving this company. But let me explain why it deserves to be on this list, why it is truly special, and why I believe it will continue creating wealth for shareholders for generations to come. Coca-Cola has increased its dividend for 62 consecutive years. That alone qualifies it as a dividend king. But the story goes much deeper than the dividend streak. I bought my first shares of Coca-Cola in 1988. At the time, some people thought I was overpaying. The stock had run up significantly. The valuation looked stretched by historical standards. But I saw something others missed. I saw a brand that had embedded itself into the daily lives of billions of people around the world. I saw a business model that generated incredible returns on capital with minimal reinvestment requirements. I saw management that understood how to allocate capital and return cash to shareholders. That initial investment of roughly $1 billion now pays us over $700 million per year in dividends. Think about that. The dividend income alone is almost equal to our entire original investment. And we still own every single share. That is the magic of owning a great dividend-growing company for a long period of time. Most investors cannot fathom that kind of patience. But patience is exactly what transforms good investments into great ones. Let me tell you a story about why Coca-Cola's brand is so powerful. A few years ago, I visited one of Coca-Cola's bottling partners in a developing country. We drove through remote villages where people had very little, no running water in many homes, limited electricity, minimal infrastructure, dirt roads, simple dwellings. But in every single village, in every small shop, there was Coca-Cola available, cold, ready to drink, affordable. I asked my guide how this was possible, how Coca-Cola reached these remote places where basic services did not exist. He explained that Coca-Cola had spent decades building distribution networks, training local entrepreneurs, developing cold chain solutions, finding ways to get their products to consumers no matter where they lived. The distribution system that Coca-Cola has built over more than a century is truly remarkable. They can get their products to virtually any place on earth where people have money to spend. That distribution network is not something any competitor can replicate. It represents billions of dollars of investment accumulated over decades, and it means that as the global middle class expands, as billions more people get disposable income, Coca-Cola will be there to serve them. This is what I mean by an economic moat. Coca-Cola's moat is not just the brand. It is the entire system they have built to get products from factories to consumers efficiently and profitably, anywhere in the world. Now, I know what some people say. They say that younger generations do not drink as much soda. Health trends are moving against sugary drinks. Coca-Cola is a declining business. Let me tell you why those people are wrong. First, Coca-Cola is not just a soda company anymore. They own over 200 brands across every beverage category: water, juice, tea, coffee, sports drinks, energy drinks. When consumers shift away from carbonated soft drinks, they often shift to other products that Coca-Cola also owns. Dasani water, Smart Water, Honest Tea, Simply Orange, Minute Maid, Costa Coffee, which they acquired to build a global coffee platform, Body Armor Sports Drink, Monster Energy, in which they have a significant stake, Fairlife Milk, Topo Chico Sparkling Mineral Water. The list goes on. The company is constantly evolving its portfolio to meet changing consumer preferences. They watch trends carefully. They acquire promising brands. They develop new products. They reformulate existing products to reduce sugar while maintaining taste. Second, even within the carbonated beverage category, Coca-Cola has been incredibly successful with zero sugar options. Coca-Cola Zero Sugar is one of the fastest growing products in the company's portfolio. It appeals to health-conscious consumers who still want the taste experience of Coca-Cola. They have invested hundreds of millions of dollars in improving the formula and marketing these options. The results have been impressive. Third, and most importantly, the developing world is just beginning its relationship with Coca-Cola. Per capita consumption of Coca-Cola products in Africa and Southeast Asia and South America is a fraction of what it is in North America. In the United States, the average person consumes over 400 servings of Coca-Cola products in Africa. Cola products per year in many developing countries, that number is under 50. As these regions develop economically, consumption will increase dramatically. That is not speculation. That is the pattern we have seen play out in country after country as they develop. Coca-Cola is investing billions in these markets, building infrastructure, developing local brands, creating habits that will drive demand for decades. The growth opportunity is enormous. The business model itself is beautiful in its simplicity. Coca-Cola does not actually manufacture most of its products. They create the concentrates and syrups, the secret formulas, and sell them to independent bottling partners who handle the capital-intensive work of production and distribution. This means Coca-Cola captures the highest margin part of the value chain while pushing the lower margin, higher capital intensity parts to partners. The result is extraordinary profitability. Coca-Cola generates massive amounts of free cash flow with minimal capital expenditure requirements. That cash flow funds the dividend, funds share buybacks, and funds strategic investments in new brands and capabilities. The dividend currently yields around 3%. With a growth rate that has averaged about 5% annually over the past decade, reinvested over time, that dividend income compounds dramatically. I have never sold a share of Coca-Cola, and I never will. Why would I? The company pays me hundreds of millions of dollars every year just for owning it. The business gets stronger over time. The brand becomes more valuable. There is nothing about this situation that makes me want to sell. The third dividend king I will never sell is Johnson & Johnson. This company has increased its dividend for 62 consecutive years, and I believe it represents one of the most misunderstood opportunities in the entire market right now. Let me explain why Johnson & Johnson operates in multiple segments. Pharmaceutical drugs, which generates enormous profits from prescription medications, and medical devices, which sells equipment and supplies to hospitals and surgical centers around the world. Each of these segments alone would be a fantastic business. Together, they create something incredibly powerful, a diversified healthcare giant that can generate steady profits regardless of what is happening in any single part of the healthcare industry. Let me tell you a story about Johnson & Johnson that demonstrates their commitment to doing the right thing, even when it costs them money. Back in 1982, someone tampered with bottles of Tylenol in Chicago area stores, lacing the capsules with cyanide. 7 people died. It was a tragedy and a crisis for the company. The FBI was involved. The media coverage was relentless. Johnson & Johnson's executives faced an impossible choice. They could do the minimum required legally, or they could do what was right. Johnson & Johnson's response became a textbook case study in corporate responsibility. They immediately recalled 31 million bottles of Tylenol from stores across the country, not just in Chicago, everywhere. They stopped all advertising. They offered refunds and exchanges. They redesigned the packaging to make tampering virtually impossible, inventing the tamper-proof packaging that every medication uses today. That recall cost them over $100 million. Many analysts thought the Tylenol brand was finished. Competitors were ready to take their market share permanently. But Johnson & Johnson put consumer safety ahead of short-term profits, and the public rewarded them with loyalty. Within a year, Tylenol had recovered most of its market share within 2 years. It was the leading pain reliever in America again. That incident happened over 40 years ago. But it tells you everything you need to know about the culture of this company. They think long-term. They prioritize trust and integrity. They do the right thing, even when it is expensive. They understand that reputation is more valuable than any quarterly earnings target. That culture is why they have been able to raise their dividend for 62 consecutive years. Now, let me talk about the business itself. The pharmaceutical segment is the profit engine of Johnson & Johnson. They have some of the best-selling drugs in the world. Medications for cancer, immunology, cardiovascular disease, and other serious conditions. These drugs generate enormous profit margins because they are protected by patents and require massive research and development investments that competitors cannot easily replicate. The research process for a new drug can take 10 to 15 years and cost billions of dollars. There is no shortcut. There is no way to skip the clinical trials or avoid the regulatory requirements that creates a natural barrier to entry that protects established players like Johnson & Johnson. Currently, Johnson & Johnson has one of the strongest pharmaceutical pipelines in the industry, with dozens of drugs in development that could generate billions in revenue. When people worry about patent cliffs, about blockbuster drugs losing exclusivity, Johnson & Johnson has consistently demonstrated the ability to develop new drugs that replace lost revenue. That is not luck. That is the result of sustained investment in research and development over decades. They have built an innovation machine that keeps producing new products. The medical devices segment provides diversification and steady growth. Hospitals need equipment, surgeons need supplies. As the population ages and healthcare spending increases globally, demand for medical devices grows steadily. Johnson & Johnson has leading positions in orthopedics, surgery, and vision care. These are essential products, not discretionary purchases. When someone needs a hip replacement, they need a hip replacement. When someone needs surgery, the surgeon needs the proper instruments. This is not like consumer electronics where people might delay a purchase during a recession. Healthcare demand is remarkably stable. And Johnson & Johnson is positioned to benefit from the aging of the baby boomer generation and the development of healthcare infrastructure in emerging markets. Here is what really excites me about Johnson & Johnson for the future. Healthcare spending is one of the most predictable growth trends in the world as populations age. They need more medical care. As emerging markets develop, they invest more in healthcare infrastructure. As science advances, new treatments become possible for diseases that were previously untreatable. Johnson & Johnson is positioned at the center of all of these trends. They have the scale, the expertise, and the financial resources to continue innovating and growing for decades. They are investing heavily in areas like gene therapy, cell therapy, and personalized medicine. These are the frontiers of healthcare where the most significant advances will come in the next 20 and 30 years. Johnson & Johnson will be there, developing the treatments and devices that extend and improve lives. The company currently yields around 3%, with a dividend that has grown at about 6% annually over the past decade. That might not seem spectacular, but consider what happens over 20 or 30 years. If you invest $100,000 today and the dividend grows at 6% annually, in 20 years you will be receiving over $15,000 per year in dividend income alone. That is before any appreciation in the stock price. That is the power of consistent dividend growth. Some investors worry about litigation risks at Johnson & Johnson. There have been lawsuits related to various products over the years, and some of these lawsuits have received significant media attention. But here's what those investors miss. Johnson & Johnson has dealt with litigation throughout its entire history. They have the financial strength to handle these challenges. They have reserves set aside for legal contingencies. They have some of the best lawyers in the world. And most importantly, their core businesses continue generating enormous profits regardless of what happens in any individual lawsuit. The dividend has never been cut. The dividend has never been frozen. The dividend just keeps growing year after year, decade after decade. That tells me the business is fundamentally sound regardless of what headlines might suggest. Now let me step back and explain the principles that connect these three companies, because the specific names matter less than understanding why they belong in a portfolio together. First, all three companies have genuine economic moats. Procter & Gamble has brand power and distribution networks that took a century to build. Coca-Cola has the most recognized brand in the world and a distribution system that reaches every corner of the globe. Johnson & Johnson has research capabilities, regulatory expertise, and relationships with healthcare providers that competitors cannot easily replicate. These moats protect the businesses from competition and allow them to maintain high profit margins over long periods. Without moats, companies are at the mercy of competitors who can undercut prices and steal customers. With moats, companies can earn superior returns for decades. Second, all three companies sell products that people need, not want, but need toothpaste. Beverages, medicine. These are not discretionary purchases that disappear during recessions. They are staples of daily life that generate steady demand regardless of economic conditions. This stability is what allows these companies to raise their dividends year after year without interruption. They do not have to worry about demand collapsing during downturns. They do not have to cut dividends to preserve cash when the economy struggles. Their businesses keep generating profits through thick and thin. Third, all three companies have management cultures that prioritize long-term thinking and shareholder returns. They do not chase quarterly earnings at the expense of sustainable value creation. They do not take reckless risks that could jeopardize the dividend. They make measured, consistent decisions that compound over time. This culture is evident in their capital allocation decisions, their approach to acquisitions, their treatment of shareholders. Fourth, all three companies have the financial strength to weather any storm. They have reasonable debt levels, strong cash flows, and access to capital markets if needed. They can survive and even thrive during economic downturns while weaker competitors struggle. Let me tell you how to apply these principles in your own portfolio, because you do not need to be wealthy to benefit from dividend investing. The most important thing is to start now, regardless of how much you have to invest. Time is the most powerful force in dividend growth investing. The longer you hold dividend growing companies, the more your income compounds, and the wealthier you become. If you are young, even small investments in dividend kings can grow into substantial income streams over time. I wish I had understood this more fully when I was starting out. I would have been even more patient with my best investments. Consider this example. If you invest just $500 per month in a portfolio of dividend kings yielding 3% with 6% annual dividend growth, after 30 years you will have accumulated over $600,000 and your annual dividend income will exceed $35,000. That is life-changing money built slowly and steadily through consistent investing in quality companies. You do not need to pick the next hot stock. You do not need to time the market. You just need to buy quality, reinvest dividends, and wait. The second principle is to reinvest your dividends until you actually need the income. This is how compounding really works. It's magic. Every dividend payment buys you more shares. More shares means more dividends next quarter. More dividends means even more shares over time. This snowball effect becomes incredibly powerful. Most of my wealth has come from reinvesting dividends and letting them compound over decades. Many people spend their dividends treating them like a bonus or extra income. That is a mistake, especially when you are building wealth. The dividends should be automatically reinvested until you actually need the income for living expenses. That is when you shift from accumulation to distribution, but during your working years, reinvest everything. The third principle is to be patient. Dividend investing is not exciting. You are not going to double your money in 6 months. You are not going to have dramatic stories to tell at parties. You are going to slowly, methodically, boringly build wealth over time, and then one day you are going to look at your portfolio and realize you have accumulated more money than you ever imagined possible, and you have a stream of dividend income that keeps growing every year. The fourth principle is to focus on dividend growth, not just current yield. A stock yielding 8% might look attractive, but if that dividend is not growing, or worse, if it is at risk of being cut, you will be disappointed over time. I would much rather own a stock yielding 2.5% that grows its dividend 8% annually than a stock yielding 6% that grows its dividend 1% annually. After 10 years, the lower yielding stock will actually be paying more income, and it will be far safer. Some people ask me if there is ever a reason to sell a dividend king, and my honest answer is almost never. If the business fundamentals are deteriorating, if the dividend is genuinely at risk, if something has fundamentally changed about the competitive landscape, then perhaps you consider selling. But short-term price declines, temporary earnings misses, negative headlines, these are not reasons to sell. In fact, they are often reasons to buy more. When Procter & Gamble struggled in 2000, the right move was to buy more shares at lower prices and reinvest the dividends. When Johnson & Johnson faced lawsuits, the right move was to stay calm and keep collecting dividends. When Coca-Cola dealt with changing consumer preferences, the right move was to trust management to adapt the portfolio. Great companies face challenges. That is inevitable. What matters is whether they have the fundamental strengths to overcome those challenges and continue creating value for shareholders over the long term. Dividend kings have demonstrated that strength through 50 or more consecutive years of dividend increases. That track record deserves respect and patience from investors. Do not abandon companies with that kind of history because of temporary difficulties. I want to leave you with something important. Building wealth through dividend investing is not complicated, but it does require discipline. It requires the patience to hold through market volatility. It requires the wisdom to ignore short-term noise and focus on long-term fundamentals. It requires the humility to accept that boring, steady returns beat exciting speculation over time. The three dividend kings I have shared with you today represent exactly what I look for in permanent holdings. Procter & Gamble with its 68 years of dividend growth and unmatched consumer brands, Coca-Cola with its unparalleled brand recognition and global distribution system, Johnson & Johnson with its commitment to doing right by customers and shareholders, and its position at the center of healthcare innovation. These are not just stocks to me, they are partial ownership stakes in some of the finest businesses ever created. Businesses that will be serving customers and generating profits long after I am gone. Businesses that will continue raising their dividends for my children and grandchildren to benefit from. That is the kind of wealth that matters. Not quick profits that come and go, but generational wealth that compounds and endures. If you can embrace that philosophy, if you can commit to owning great businesses and holding them through thick and thin, you have everything you need to achieve financial independence. The path is simple. The execution requires patience. And the rewards are worth waiting for.